This is dollar logic, where we break down the hidden logic behind money, business, and the systems that shape your everyday life. No jargon, no fluff, just clear answers. You deposit your paycheck into a bank account and the money just sits there. Or at least, that is what it looks like from your side of the screen. In reality, the moment your money lands in that account, the bank starts putting it to work, and the gap between what they earn on it and what they pay you is one of the most profitable arrangements in modern finance. Today, we are breaking down exactly how banks make money with your money. Start with the basic mechanic, fractional reserve banking. When you deposit money, the bank does not lock it in a vault with your name on it. It keeps only a fraction available for withdrawals and lends the rest out to other customers as mortgages, car loans, business loans, and credit cards. Your deposit becomes someone else's loan, and that loan generates interest income for the bank. The core of the business is something called net interest margin. It is the difference between what a bank earns on the money it lends and what it pays out to depositors. According to FDIC data, the average net interest margin across the U.S. banking industry was around 3.39% at the end of 2025. That spread does not sound dramatic, but applied across trillions of dollars in deposits, it becomes enormous. The entire U.S. banking industry earned roughly $295 billion in net income in 2025. Here is where it gets personal. As of 2026, the average savings account in America pays somewhere between 0.38 and 0.62% annual interest, depending on which survey you look at. Some of the largest banks pay as little as 0.01%. Meanwhile, high-yield savings accounts, usually offered by online banks, have been paying around 4%. That is roughly 10 times more on the exact same deposit for the exact same level of federal insurance protection. Now look at the other side of the ledger. In 2026, the average 30-year mortgage rate sat near 6.7%. Average auto loan rates ran around 6.4% for new cars and over 11% for used cars. Personal loans averaged over 12%. So a bank might pay you well under 1% on your deposit, then lend that same money out at 6, 11, or 12%. The spread is the business. But interest is only half the story. Banks also generate what is called non-interest income, money that comes from fees rather than lending. Overdraft and insufficient funds fees are one of the largest categories. Research from the Financial Health Network estimated that American consumers paid roughly $12.1 billion in overdraft and NSF fees in 2024. The average overdraft fee sits around $27. What makes overdraft fees especially notable is how concentrated they are. Only a small share of accounts overdraft frequently, but that small group generates the large majority of total overdraft revenue. In other words, a relatively small number of customers, often those with the least financial cushion, are funding a very large revenue stream. There is an important regulatory update here that many people have wrong. In late 2024, the Consumer Financial Protection Bureau finalized a rule that would have capped overdraft fees at $5 for large banks, set to take effect in October 2025. Congress repealed that rule, and the repeal was signed into law in May 2025. So the $5 cap never actually took effect. If you heard that overdraft fees were being limited, that change was reversed before it started. Some banks have voluntarily eliminated overdraft fees on their own, but that is a business decision, not a legal requirement. Beyond overdrafts, banks earn monthly maintenance fees on accounts that fall below minimum balances, out-of-network ATM fees, wire transfer fees, and interchange revenue. The small percentage merchants pay every time you swipe a debit or credit card issued by that bank. It is worth understanding what your deposit is actually protected by. FDIC insurance covers $250,000 per depositor, per insured bank, per ownership category. That covers checking accounts, savings accounts, money market deposit accounts, and certificates of deposit, including accrued interest. It does not cover stocks, bonds, mutual funds, or cryptocurrency, even if you bought them through your bank. Since the FDIC was created in 1934, no depositor has lost a single dollar of insured funds. The Federal Reserve sits behind all of this. The Fed sets a target range for the federal funds rate, which as of mid-2026 was 3.5 to 3.75%. When the Fed raises rates, banks can charge more on loans and earn more on the reserves they hold, and they can afford to pay depositors more, though they are under no obligation to. When the Fed cuts rates, savings yields tend to fall relatively quickly, while loan rates often come down more slowly. That asymmetry is the part most people never notice. Banks are generally quick to raise the rates they charge and slow to raise the rates they pay. This is not a conspiracy. It is simply how a competitive but sticky market behaves because most customers do not switch banks over a fraction of a percentage point, even when the difference adds up meaningfully over time. So what does this mean in practice? First, know what your savings account actually pays. If you are earning 0.01% while high-yield accounts are paying near 4%, that gap on a few $1,000s is real money each year, and it costs nothing but paperwork to move. Second, understand your account's fee structure, minimum balance requirements, overdraft policies, and ATM networks, because those fees are entirely avoidable once you know they exist. Third, confirm your bank is FDIC insured and that your balances sit within coverage limits. None of this makes banks villains. They provide payment infrastructure, credit, and security that a modern economy genuinely requires, and the spread between deposits and loans is how that system funds itself. But the system is built on the assumption that most customers will not read the fine print, will not compare rates, and will not move their money. Understanding how banks earn from your deposits is what turns you from a default customer into a deliberate one. That's how it actually works. Understanding money doesn't have to be complicated, it just has to be explained clearly. If this helped, subscribe to Dollar Logic for more videos that make sense of the systems around your money. See you in the next one.